Hey there, Dave Dubeau with another episode of the Property Profits Real Estate Podcast. Welcome to this new year of episodes. And let me ask you a question. You've probably heard of buying and renting out commercial properties. Well, today's guest, our old friend, Agostino Pintus, who I've interviewed a couple of times before, is going to be sharing with us all about net lease investing. So, Agostino, great to see you again, my friend. How are you doing?
Man, I'm awesome. Thanks for inviting me back. Appreciate it. It's always a pleasure talking to you, my friend.
Well, it's always a pleasure as well. And Agostino is a very, very sharp real estate entrepreneur. He's been in the field for over 2 decades. He's done all sorts of stuff. Last time we interviewed him, we were talking about him buying a Rockefeller building in Cleveland. That's where he's at right now. He's got the Bulletproof Cashflow podcast. He's a going concern. He was just showing me some new build construction that he was working on as well. Exciting stuff. Very, very active real estate investor. But Agostino, today we're going to really, really focus on this whole net lease investing side of things that you're really getting into at this time under these economic circumstances. So job number one is, for folks who aren't familiar with what net lease investing means, what does that mean to you?
So basically, net lease is the stuff that we focus on anyways, corporate-backed commercial property.
Corporate-backed commercial property. So what is an example of that we can all just get our head around?
So Dollar General, think of a single freestanding Dollar General or a Dollar Tree or an Advance Auto Parts or a CVS or a Walgreens. These types of stores, or even a Walmart for that matter, giant, that's a big box, right? But it's still the same sort of scenario, right?
Yeah. So basically it's one of these commercial businesses, like a dollar store is a great example. It's not necessarily part of a strip mall. It's a standalone property. Is that correct? Perhaps
correct.
Its own parking lot or what have you.
Yeah, exactly. It could be part of a strip mall. We don't focus on that. We want a single tenant asset because we know that those tenants prefer those types of deals as well. They want to have their own building, typically. So like Advanced Auto Parts, typically they have their own building. They don't usually like doing the whole share space model, right? Mm-hmm. And plus it also gives us more control over the real estate too. So it's
are you buying these as existing properties that already have these kind of tenants in them, or are you building them from the ground up for this kind of a tenant? How does that typically work?
The good question. So we actually have a blind pool fund. So when we go and raise capital, same way we have done in the past, it's basically a blind pool fund. It's sort of like syndication, same concept. We take this cash, and then what we do is we go and purchase a bunch of these existing assets already in place. They're already built. There's already a lease in place. But what we're doing is we're buying the land, the real estate, or rather the improvement, the building, and the lease itself, right? And these leases are all corporate-backed, guaranteed leases. So if you think about it, if you have 5 or 6 or 10 of these different stores, Dollar General, Dollar Tree, you have an Advanced Auto Parts, you have a DaVita dialysis center, you have all these different companies, and they're all promising you that they're going to pay the rent every single month. For the investors in these type of deals, as you can imagine, it's very, very nice to receive a monthly check that comes in. It's beautiful, right? Certainly, it's a risk-adjusted return. It's not multifamily. It's not development. It's a different type of deal. However, that corporate guarantee allows you to sleep at night knowing that you have regular income coming in, and you still own the real estate. You still get all the depreciation. You still get all that fun stuff that really comes with owning real estate itself. So it really is a great deal, considering especially where we are in the economic cycle.
Okay, so you mentioned earlier that you're buying the property. You're also buying the improvement on the property, and you're buying the lease. Correct.
Correct. Yep.
All right, Agostino. So what you're talking about here is you're buying the property, you're buying the improvement on the property, and you're buying the lease that goes along with that. So it makes it's not one of these kind of investments where you're looking for a big uplift. You're not going to be doing massive improvements on the property. It's a nice, stable, safe, secure kind of investment for you and your investor partners. Is that what I'm understanding here?
That's exactly it. So usually people might have heard the term floating around like triple net lease or net lease or whatever. That's exactly what this is. It's there's an upside and a downside, right? When it comes to multifamily, for instance, when you buy a B or C class asset, you go in, you make the property better, you turn a bunch of units, you increase the rents, you have maybe you can negotiate a lower tax bill if you have a good attorney. There's a variety of different levers you can pull on a multifamily deal. On a net lease deal, on the other hand, first off, if it says triple net, it doesn't always mean triple net. What really matters is understanding what it says inside the lease. The lease tells you everything, who's responsible for what, right? So when we buy our assets, when we buy these types of properties, we have to take a granular look at what are we responsible for? What's the tenant responsible for? How much money do we set aside in case we have to fix a roof or do other type of maintenance that is not normal, right? So there's a great deal of effort involved there. But the cool thing is that the responsibility typically for a landlord is very, very limited,
right,
and very, very predictable. So if you know what these costs are going to be, the returns are going to be much, much more predictable too, right? So very different than multifamily. Like COVID, for instance, net lease properties, they thrived in COVID. They did phenomenal in COVID, right? Multifamily, some multifamilies had problems, right? And as a matter of fact, because again, it's really indicative of where we are in the economic cycle today, right? These types of businesses that I'm talking about, you have your fast food joints, you have your Dollar General, Dollar Tree, Advanced Auto Parts. When someone's losing their job or they're tight on cash, they're not going to go out and buy a brand new car. Right. They're going to go to Advanced Auto Parts and they're going to buy a new alternator, take it home.
See, that was a question was coming to my mind right now, was because we've heard so much in the news throughout the pandemic and even after, that retail has just taken a crap kicking. We got Bed Bath and Beyond, which is, verging on the edge of bankruptcy kind of thing, and these different, big box stores. So you're really, really picky about the kind of business that's in these properties pre-existing. You want to make sure that you're buying a property that's got a recession-resistant, recession-proof type business in it. Is that what I'm hearing?
Precisely. Think of it like there's got to be an element of it being Amazon-proof or Walmart-proof, right? That's like, for instance, if your alternator blows up on your car and you like to work on cars, so you have all the tools, you have a space. You're not going to order an alternator from Amazon and wait 24 hours. Right. I need my car right now. I'm going to go down to the Advanced Auto Parts. They have it in stock. I'll go get it and install it. And I'll have it done in 45 minutes, right? It's that kind of scenario. Like the people that go to these types of places, they need it right now, usually, right?
So same with a dollar store type place, Dollar Tree type place here.
Exactly.
Folks, that's kind of an impulse purchase or what have you, just drop in. They're pretty recession resistant. Yeah, that sounds good.
Or food or fast food too. You can't order fast food from Amazon. If you're usually for people, they're going to roll into a McDonald's, grab a meal and go on their way and then go into the office or whatever they're doing. Right. So it's those types of very, very specific business. So like I said, in the green room, right, the assets that we're looking to buy are recession resistant, so to speak, but they're also corporate backed. So we're not getting like just some random hair salon or some rando business that doesn't have any scale. Like nothing wrong with those guys. I don't hate them. It's just not what we're buying. We only buy companies and leases that have these corporate backed guarantees. That's what we want, because we want to make sure that we can provide our investors a good, healthy return and not have to worry about Dollar General going out of business. They're not going to go out of business tomorrow.
Well,
I'm not a fortune teller, but that
brings up another question here, Agostino. So you're looking for these kind of primo type properties. Isn't there a lot of competition for these kind of properties? Wouldn't the big guys, the REITs and retirement funds and those kind of things be looking for these kind of properties to buy en masse and then kind of lower the returns for you and your investors?
There are, and I would also add, though, that, there's a lot of these deals out there. A lot. I imagine like in a single day, just drive around for half an hour, you'll probably drive by hundreds of these types of locations, right? Yeah. The issue, though, is that as of right now, the cost of money has, as you know, escalated. It's very tough to find good deals. It's true. Typically, those big REITs, the big boys, are looking for a different type of of cost, so to speak, right? They're looking to spend more money on the deal.
Right.
So it depends on the deal. It depends on a lot of things, of location. If it's a secondary, tertiary market, primary market, there's certain places that we avoid. There's certain places those guys like we typically avoid blue states. I'm not getting political, but we all know blue states have a lot of red tape, and we try to stay away from that. Higher taxes, people don't want to be there. So we try to go to areas that the asset could thrive. So there's a great deal of selection, but there's a lot of inventory. But a lot of it comes back to the old multifamily game of having broker relationships. You have to. That took a while for us to really build. I mean, it's just, you don't just go in and start buying these things. It takes a while to build the broker relationships. You have to have the cash available. You have to have the lending available if you're using lending, and you have to make sure that they'll pull through and they won't leave you at the altar and actually perform. So you're right. There's a lot of competition, but a great deal of it comes in our ability to show that we can actually close. That's a real big part of it. So fortunately, we have a very good track record on our other parts of the business, and we've been able to execute every single time. We have never walked away from a deal ever. So
what kind of lengths of leases are you typically looking at in these kind of properties?
That's a fascinating idea. Hold that thought for a second. Hi there, this is Dave Dubeau, and real estate investors hire me to raise capital the right way. Why? Because most of them are stuck with too small of a portfolio, and they don't know how to attract investors and raise money for their deals. So I help them to connect, capture, and close their ideal money partners. Bottom line, when you've got a deal, you're going to have the capital to do it. So go ahead and book a no-cost capital clarity session with me at bookachatwithdave.com. Again, that's bookachatwithdave.com.
That's a good question. So what we typically do is a strategy called blend and extend, right? So under normal circumstances, the deals that you're probably thinking about are say a brand new or somewhat maybe 2-3 year old Dollar General that still has maybe 10 to 15 years left on the lease. Those types of deals, even today, are probably trading at a 6.5 cap. Okay, not bad. However, what we're trying to target these days is a fairly healthy return, a healthier return. We're looking for a little bit higher number. So therefore, what we typically do is we're using this blend and extend model. Right. What that means is that there might be say 2, 3, 4 years left on a lease.
Yeah.
But we're very, very confident that they're going to stick around. Maybe we have a few conversations with the folks at the branch, at the headquarters. We look at the vehicles per day. We look at a bunch of other demographics in the local area. And once we get comfortable in understanding that, yes, they're going to be around, they've had a great deal of success. Store sales are X. We know, for instance, we have a technology that'll tell us how many people go into that location every single day. We know, right? So if it has
is that a technology? Is somebody sitting there counting them on a clicker?
It's these things right here, these cell phones. That's how they know, man.
Wow.
That's how they know. So all the big boys, AT&T, Verizon, all those guys, they sell this data, location data, to these private companies, and they report back to say where, who's going into a certain location. So
we all take our phones all the time. So
your phones everywhere you go, right? Yeah, but what we do is we look at the competitive stores that are nearby. How many people are they getting in there? How many people is the subject store getting in? So we put a great deal of thought behind it, and we also think about what's the worst case scenario. Let's say, for instance, you know what, they pull out. Great. Well, if we're comfortable that the vehicles per day is strong, the asset is a good location, we still own the real estate. We own the real estate. So for us to take it and repurpose it into something else, it's certainly an option as well. Certainly, we're not looking to do that, but if we ever had to,
by repurposing, you mean getting a different tenant in there?
Get a different tenant in there. Yeah. And the thing is, though, it's like Dollar General, Dollar Tree, for instance, they average about 9,000 square feet, right? So typically, we're trying to find that type of location, right? And they usually go up, but they never go down. Meaning, you might have seen a Dollar General go into, or a Dollar Tree rather, go into an old CVS location, right? But they'll never go from a CVS location back into a smaller unit, right? So you have to consider all these different things, like what are the vacancies in the area. So there's a great deal of thought that goes into.
What I was going to ask you, Agostino, with this is, let's say you get a property that's got 2 years left on its lease. You're pretty comfortable that the tenant's going to continue with a new lease after that. How does it typically work? Just big, broad strokes for that new lease. Like, are you setting are you bumping up the rent significantly typically at that time, or is it kind of a gradual continuation? How long does the new lease go for typically? How does that kind of look?
The lease says everything, meaning some stores, I don't want to throw out any names here, they were doing a flat, no rental increases for 15 years.
Wow.
I would never do those deals, by the way. I wouldn't. It just doesn't make any sense, because especially now, like, we printed off trillions of dollars over the past 2 years, 3 years now. The price, the value continues to go down, or the value of the dollar continues to go down. So you have inflationary pressures, and taxes are going to go up. I would never do that deal, right? So it depends on the lease, right? Most times there's a provision to bump up the cost, or bump up the rent 5%, 3% every year, every 2 years. It depends. It just depends, right? And those guys have good negotiators, right? And some of these stores, like I think it's Dollar General, they're very, very, very hard nosed about how they negotiate their stuff.
Yeah, their margins are pretty thin, so their
margins are pretty thin to begin with, right? So some of these guys are tough, and there's also no guarantee, by the way, that let's say they do stay in that location, that they're going to say, okay, great, now we want to renegotiate our lease, and now this is what we're going to pay. That certainly can happen too, right? So the brokers will never tell you that, but it can happen. So the ability to back up your data, or back up what you're saying with data, like the way that we do, is very, very important when you're negotiating that, because it becomes a brand new negotiation with a brand new lease, right?
Exactly.
So yeah. So you have to be able to back it up.
So is it typically kind of continuing on with the previous lease that they have, perhaps at a new price point type thing, or what have you seen in your experience?
Yeah, well, it's exactly it. That's exactly it. So if you think about a timeline, right? If you're starting at zero, has a lower cap rate, but as you go on and on towards the end of the lease, the cap rate continues going up. I never talk about cap rate when it comes to multifamily. I think it's stupid, because all cap rate truly is in the world of multifamily is an indication of where the asset's located and the level of risk you're taking on acquiring that asset. Right. Certainly it's a mathematical equation. I get it, but I never make a decision just based on cap rate. When it comes to net lease, it's a little different. Cap rate becomes very important, right? Because the cap rate will tell you, at least initially, how much the cost of the asset is, and then you know how much the cost of debt is. And if there's not enough margin between the two, you can't do the deal, Right. So there's stuff that's trading right now in like California. They're still trying to sell this stuff at a 3.2 cap. How? It's like, you can't do it. Like, not even you're losing money on the deal. Even for someone that pays all cash for those deals, which people do, by the way, they'll just buy like Dollar General, like the whole location in California for like $4 million, depending on the size, of course, and they'll lose money on the deal. I don't know who would do that, but people do, I guess. Otherwise, wouldn't be selling it. But then again, I think what they're looking to do is to get someone on the hook so they can negotiate. That's what they're looking to do, right?
Right. Oh, fascinating stuff. Agostino, time always flies when we're having fun. If people want to find out more about you and what you're up to in your podcast, where should they go?
Bulletproofcashflow.com. Certainly go to the website. You can also check us out on Facebook. We're on LinkedIn, or we're even on TikTok. Can you believe that? Although I do not do any dancing on TikTok.
Well, I was going to ask, how's your dancing skills?
Very poor. However, I do talk about making money. I think that's something that people ought to be doing right now.
Nice. All right, my friend. We'll make sure we got all that in the show notes. And thank you very much.
You bet. Thanks for having me on.
All right, everybody. Take care. See you on the next episode.
Well, hey there. Thanks for tuning into the Property Profits Podcast. If you like this episode, that's great. Please go ahead and subscribe on iTunes, give us a good review. That'd be awesome. I appreciate that. And if you're looking to attract investors and raise capital for your deals, then I'm going to invite you to get a complimentary copy of my newest book, right back there. There it is. The Money Partner Formula. You can get a PDF version at investorattractionbook.com. Again, investorattractionbook.com. Take care.